What's up everyone, welcome to a new investing video from PerFinEx, the #1 English speaking and independent financial planner in Germany. As I feel some of you are getting worried when you look into your portfolios, let us talk about investing in times of corrections today. Especially US markets have been hit tremendously hard, with the S&P 500 having its worst start since 1939 and the NASDAQ since 2008. And bond markets are falling as well. There is one person that we can learn from in times like these, and that is Peter Lynch that you are seeing here on screen right next to me. Peter Lynch ran the most successful fund in the world for over a decade. He has seen it all and he certainly knows how to make money even in times when the market is correcting like right now. So let us take a look at the history of market correction and Peter Lynch 3 investing rules during market corrections in episode 10 of our community investing. That's what we're discussing today, and as always, everything is linked in the timeline, so if you're interested in any specific part or want to skip some stuff, you can do so with the timeline in the description. Here you can see Peter Tuchman, probably the most famous trader on the floor of the New York Stock Exchange. He doesn't look so happy. Why not? Because we're in a full-blown market correction right now, that's why. And just in case this has you worried as well, here's a chart of the last 26 corrections since World War II, not including the COVID correction or the one we're currently in. Also not including Black Monday 1987, a day in which the stock market lost 22% in one single day. So it's actually not 26 corrections until today, it's 29 corrections until today. About one correction every 2 to 3 years. 29 times the market declined by more than 10%. Actually by an average of 13.7% over 4 months. And coincidentally, it also takes 4 months for the market to recover. The current market conditions are pretty severe, with the S&P 500 being down by over 20% since the start of this year. So I can understand that some of you are worried. It's also not fun for me doing these videos in times like these. Believe you me. At least over the last week or two, the market recovered a little bit. It's 5 months of decline now, so statistically speaking, it could be over already. We'll see what happens and try to adapt. What we will not do, and what you shouldn't do either, is to stop investing right now and cash out. Why not? If you would have bought the S&P 500 exactly 100 years ago and just sat through all market corrections, you would have made a staggering return of more than 57,000% of your initial investment, and more than 2.5 million if you would have reinvested all dividends that you got over the century. I know that some of you expected that we anticipate the current correction and act accordingly. Some of you even send us friendly messages.
Why don't you guys sell right before the crash?
Not sure where some of you got the idea from that we can predict the future. But let me just state this here very clear. If you invest with us, I'm very happy. But if you invest with us because you expect us to predict the future and make a positive return in every market scenario, please cancel your investment account today and unsubscribe from our YouTube channel. These are extremely unrealistic expectations that we will never be able to fulfill. So if you expect us to predict the future, do us all a favor and let us part ways here. Because the 2.5 million% return shows us that there's no need for anyone to predict market crashes. And that's also what arguably the most successful fund manager in human history teaches us with his 3 investing rules through a market correction. Let's just sum it up like this. By investing in the market, you will improve your financial future over the long term. And the price all of us have to pay to achieve our financial goals is that we have to stomach the volatility without going crazy. And hopefully Peter Lynch can help us all with that. In case you don't know who Peter Lynch is, he was manager of the most successful fund in the world for over a decade. doubling the S&P 500 return consistently in that time, giving investors an annual rate of return of 29.2%, more than twice the market return. That's an incredible track record, and that's why we can certainly learn something from him here. What is the investing legend saying about investing in market corrections? Rule number 1, the stock market goes up and down. We've seen it just a slide before. Peter Lynch's advice is to not focus on these macroeconomic developments or market corrections, or otherwise you will destroy your investment portfolio. And my personal advice to this is to not focus on the media either, with their clickbaity headlines that are just trying to scare you. Lynch's tip is to focus on the underlying companies that you're investing in, because their fundamentals will rule over market cycles over the long term. In other words, ignore the ups and downs of the market. Don't get scared because the market drops. Ask yourself why the market drops, and if that requires you to change your investment portfolio. If your investments go down simply for the fact that the overall market is getting hammered, you will be fine in the long run. Rule number 2. Peter Lynch loves volatility, as it gives him the opportunity to buy at cheaper prices. And that's what I've been telling you here in these episodes since February. You can go check them out yourself right here on this YouTube channel. Since February, I'm telling you guys to slowly but steady continue investing, because the market will go up at some point. Because the underlying investing strategy that we have is bulletproof. Nobody knows where the market will be in 1 week, 1 month, 1 year from now. What we do know is that with the right investing strategy and 5, 10, 20 years to invest, you will be fine. Rule number 3. Corrections, crashes, bear markets, whatever you want to call them, happen regularly. And there is nothing you or me can do about it. Markets up, market downs, market spinning in circles. It's all part of the investing journey. And Lynch argues that if anyone tries to time the market, predict corrections, and changes his entire portfolio because of that, he will lose far more money than just sitting through the downturn and waiting it out. And that's also why we told you to continue investing if you have a long-term investing horizon. Hopefully, the advice of Peter Lynch helps you to stomach the current market correction and all corrections after that, because we know they're gonna happen. And hopefully it also helps you to make some money together with us as soon as the market recovers, because we are investing strategically. Portfolio updates. Our high safety investing strategy that invests mostly in global corporate bonds, about 80%, and the other 20% in global stocks, is also down, but very little compared to the stock market. As safety is the number one goal in this investing strategy, we shouldn't lose more than 15% from the peak. Looks like the market is about to recover, slowly, maybe steady, after all these months of negative. We'll see what happens. And this is also the only investing strategy that didn't return a dividend in May. With a 2.5% dividend yield so far, our total loss since August last year stands at 0.7%, minus 3.2% in price decrease, plus the 2.5 dividend that have been paid out. Passive income return dividends, of course, because that's what the investing strategy is supposed to do. 2 dividends, in fact, amounting to a little over 20 euros if you would have 10,000 euros invested. With the May dividend, we reached a payout every single month since the start of our community investing last August. Even though December, as you can see, was really small. This month we are down minus 2.6%, coincidentally also the overall loss since the start in August last year. With our 1.8% dividend yield, we stand at a total loss of 0.9%. We are much better than the overall market, but still negative. And depending on when you started investing with us, your portfolio can be down a little more, of course. Depending on when you exactly buy with your monthly or bi-weekly savings plan, and depending on when you started exactly. All these charts here that you can see are starting with 10,000 euros one-time investment in August last year. We learned earlier from Peter Lynch that return comes from risk. Remember? That is certainly true for our high return investing strategy that got hit the hardest. Minus 3% last month, leaving us with minus 8.8% since last August before the dividends. As with all other investing strategies, we see a small sign of life over the last week or two. Fingers crossed that this is the start of the recovery. We'll keep you posted on recent developments if something comes up before the video next month. May paid also a dividend, resulting in a 1% dividend yield so far, which leaves our total return at minus 6.8%, factoring in the dividends and the realized gains from the last times that we shifted the portfolio for you guys. If you would like to join our investing community, maybe now is the time. We'll see what happens. You can open your personal Fidelity investment account completely online in just a couple of minutes. The regular account is fine, there's no need for this plus account. After you finish your registration, Fidelity will send you an invitation to identify yourself either with video ident or with post ident offline. Very important, if you don't identify yourself, your account will not be opened. So please try to do it. If it doesn't work for whatever reason, sometimes people have passport problems, let us know. We'll try to help. After you identified yourself, it usually takes Fidelity a day or two to open your investment account. We will see it before you do, because we can see it electronically. You have to wait for your login details to arrive by post. And that's when we will reach out to you with a meeting invitation so we can discuss the right investing strategy for your personal financial goals. Let's hope that the correction is over. Statistically speaking, it is. We'll see you next month. Take care, guys.